Welcome to Module 16 of the Introduction to Bond Markets Qualification. In this module, we'll be discussing securitization and covered bonds. By the end of the module, you should be able to define and give examples of securitization, list motives for securitization, explain how a securitization is structured, and explain how credit risk is transferred and managed in a securitization. You should also be able to describe the structure of a covered bond and compare covered bonds with securitizations. Let's begin by talking about securitization. Securitization is a structured finance technique in which assets or receivables that generate cash flows are purchased by a special purpose vehicle or SPV that simultaneously issues securities that are sold to investors. The price paid by the investors for the securities is used to fund the purchase of the assets, and cash flows generated by the assets are used to pay interest and principal on the securities. The securitized assets or receivables are sometimes referred to as the collateral or the collateral pool. The purpose of securitization is to convert illiquid assets into a security or securities that can be sold to investors. You are likely in the market to encounter many different types of securitization. Among the most common are mortgage-backed securities, or MBS, based either on residential mortgages or on commercial mortgage loans. These may be either private securitizations or, in some cases, securitizations by government-sponsored enterprises, such as the mortgage agencies in the U.S., Fannie Mae, Freddie Mac, and Ginnie Mae. There are also securitizations based on a wide range of consumer loans, such as credit cards, auto loans, or student loans. We give the generic name asset-backed securities, or ABS, to these other types of securitization. Less commonly, you might encounter a whole business securitization, which is based on the receivables of an entire operating business. For example, ticket revenue from a sports franchise, or the royalty stream from a set of intellectual property. Finally, there are also more complex securitizations in which the SPV issues several different classes of securities, each of which has a different priority claim on the collateral assets. We call these more complex securities collateralized debt obligations, or CDOs. In this introductory course, we won't be discussing CDOs. Why might an entity decide to securitize a set of assets? There are two main motives for securitization that drive the market: cheaper funding and credit arbitrage. The securitized assets may have lower credit risk than the originator, or they may be a statistically more reliable source of credit risk. In each of these cases, the originator might be able to reduce their funding costs by segregating these assets into a collateral pool that can then be securitized. Because securitization is in part about creating liquid securities on the basis of less liquid collateral assets, it may also be the case that the originator or manager of a securitization can extract some profit by demanding from investors in the securitization a premium for granting them access to a pool of collateral or credit risk to which they would not normally have access, such as, for example, mortgage loans, consumer loans, auto loans, and so on. More generally, securitization is an alternative funding source for many originators. For example, a bank that creates mortgage loans may use securitization as a means of funding those loans as an alternative to more traditional funding sources such as deposits from customers. There are two other motives for securitization that, while they were once very important drivers of the market, have become less important in recent years. The first of these is balance sheet benefits. Removing receivables from the balance sheet may improve an institution's return on capital. Because, for example, a bank could earn the income from originating mortgages, then move those assets off the balance sheet through securitization, and be able then to create space on the balance sheet to originate a new set of loans. But this kind of off-balance sheet treatment has become increasingly difficult to achieve under current accounting and regulatory practices. Another formerly significant driver of securitization was the desire by financial institutions to reduce their required regulatory capital. This has become much less significant since the financial crisis, however, as regulatory reforms have imposed much stricter capital requirements on financial institutions. So let's take a closer look at how a securitization might be structured. We begin with the originator. This might be, for example, a bank that has created mortgage loans that it wishes to securitize. The originator earns receipts from its operating business, and some of those receipts come from the set of assets, for example, the mortgage loans, that are to be securitized. Those assets that are to be securitized, of course, generate income, for example, the interest payments and principal repayments on the mortgage loans. The originator separates or segregates the assets or receivables to be securitized, and then creates a special purpose vehicle for the purpose of managing the securitization. The originator then transfers the rights to the receivables to the SPV in exchange for the purchase price. The SPV now owns the rights to the receivables, so it will be receiving the income that they generate. The SPV finances its purchase of the rights to the receivables by issuing asset-backed securities in the securitization, which it sells to investors. The income that is generated by the securitized receivables in the collateral pool is used to finance interest and principal payments to the investors in the securitization. In this way, the income from and the exposure to the collateral assets is transferred to the investors in the securitization. Now that we've seen how securitization is structured, we can take a closer look at how credit risk is transferred and managed in securitizations. As we've seen, securitization often involves a true sale of the underlying receivables, or the collateral, to the SPV. It's very important that the SPV be established in such a way as to ensure that it is both insolvency remote, that is, that it is unlikely to be subject to insolvency proceedings, and that in any event it will be unaffected by the insolvency of the originator, and that it is treated separately from the originator, for example, in the case of any insolvency proceedings. These steps are necessary to protect the investors in the asset-backed securities from any claims that might be made by creditors of the originator should the originator become insolvent. Our objective is to create a structure in which the investors in the securitization are exposed only to the risk that is in the collateral pool and not to other risks that might be associated with the originator. In some cases, The economic interest in the receivables may be transferred to the SPV through a sub-participation rather than a true sale, or the originator may place the receivables in a trust with the SPV as the beneficiary. It's very common for additional steps to be taken to enhance the credit quality of the securitization. For example, there might be some degree of over-collateralization. That is, the total value of the collateral assets that's held by the SPV may be greater than the nominal value of the asset-backed securities that it issues. This ensures that if there are losses on the collateral, for example through default, there'll be a cushion to absorb some of those losses before they affect the payments to the investors in the securitization. There may also be some retained spread, that is a difference between what the SPV earns on the collateral and what it pays the investors in its securities. Again, this provides a cushion to protect the investors in the securitization from loss. It was once common for securitizations to rely as well on external insurance provided by specialist bond insurers. But this so-called monoline insurance industry suffered severe damage during the financial crisis, and reliance on external insurers is now much less common. Finally, the SPV can enhance the credit quality of some of the securities that it issues by creating other securities within the same securitization that are linked to the same collateral pool but are subordinated to them. This so-called tranching is what underlies the creation of the collateralized debt obligations, or CDOs, that we described briefly earlier in the module. Now that we've explained how a securitization is structured and how credit risk is transferred and managed in a securitization, we should also look briefly at how securitization compares with covered bonds. Covered bonds are debt instruments issued or in some cases sponsored by a financial institution and secured by a priority claim on a specified pool of high-quality collateral, typically mortgage loans or public sector loans. Investors in covered bonds have dual recourse in the event of insolvency against both the issuer of the covered bonds and against the collateral pool that covers the bonds. So the key differences between covered bonds and securitization are the following. First, the assets in the cover pool in a covered bond typically remain on the issuer's balance sheet rather than being transferred in a true sale to an SPV as in a securitization. Secondly, the cover pool in a covered bond is dynamic rather than static. That is, it changes over time. It is possible to have securitizations with dynamic collateral pools, but many of the examples that we discussed earlier involve static collateral pools. Thirdly, the principal and interest on a covered bond are paid from the issuer's general business receipts, rather than from the cash flows generated specifically by the cover pool. And fourthly, and most critically, investors in covered bonds have recourse against both the issuer and the cover pool, whereas in securitization, they only have a claim on the collateral pool. This is almost certainly the key difference between covered bonds and securitization. Finally, in the event of bankruptcy or insolvency of the issuer or sponsor bank, covered bonds do not accelerate. That is, they do not become immediately payable in full. And the bonds and their collateral assets are treated separately from the issuer's post-bankruptcy procedure. Covered bonds are an important part of the European fixed income market, especially in countries such as Denmark, France, Germany, Italy, Spain, Sweden, and the United Kingdom. And there are important covered bond markets in many other parts of the world. The covered bond market has its origins in the Pfandbrief system, created in 18th century Prussia, so it certainly has a very long history. During that long history, the structure of covered bonds and the regulatory framework in which they're issued has changed significantly. But in 2019, a common legislative framework for covered bonds was introduced in the European Union. Covered bonds offer a stable source of long-term financing to banks that is at least arguably less exposed to the problem of moral hazard than securitization. One concern about securitization is that the ability to move assets off the balance sheet through securitization may reduce the incentive the originating institution has to think carefully about the credit and other risks associated with those assets. In covered bonds, as we've seen, the assets remain on the balance sheet, and the investors in the covered bonds have recourse both to the collateral and to the issuer in the event of default. These features of covered bonds go some distance towards addressing the problem of moral hazard.